Hello and welcome to the LP Financial Services Forex Training Class, Introduction to Technical Analysis videos. In Lesson 1, Chart Patterns, we are now ready to talk about pattern number 7, the Ascending Triangle Pattern. An ascending triangle pattern is easily recognizable by the distinct shape created by two trend lines. In an ascending triangle, one trend line is drawn horizontally at a level that has historically prevented the price from heading higher, which is called resistance. The second trend line connects a series of increasingly higher troughs. Traders enter into long positions when the price of the asset breaks above the top resistance. An ascending triangle is generally considered to be a continuation pattern, meaning it is usually found amid a period of consolidation within an uptrend. Once the breakout occurs, buyers will aggressively send the price of an asset higher. The price target is generally set to be equal to the entry price plus the vertical height between the two trend lines of the triangle. Can you see the ascending triangle pattern? When we take a closer look at pattern number 7, the ascending triangle pattern, we see a rise. The market has a hard time breaking this level, which becomes resistance and forms the top line of our ascending triangle. With each trough we see or dip against the trend, the market is higher, and that's connected with another trend line. This forms the ascending triangle pattern. Upon the breakout, the market will aggressively push higher. The ascending triangle pattern is a continuation pattern, meaning it is at a period of consolidation within an uptrend. The target is calculated by taking the distance from the highest point of the resistance area and taking it to our lowest trough. Add this to the top of the resistance area to come up with a great target area. This has been a fine example of an ascending triangle pattern. In pattern number 8, the descending triangle pattern, we see that the descending triangle pattern is a bearish chart pattern that is created by drawing one trend line that connects a series of lower highs and a second trend line that is historically proven to be a strong level of support. Traders watch for a move below support as it suggests that the downward momentum is building. A descending triangle is generally considered to be a continuation pattern, meaning that it's usually found amid a period of consolidation within a downtrend. Once the breakdown occurs, traders enter into short positions and aggressively push the price of the asset lower. The price targets are generally set to be equal to the entry price minus the vertical height between the two trend lines of the triangle. Can you see the descending triangle pattern? When we take a closer look at the descending triangle pattern, we see that the market had dropped a few times but could not break this level of support. Each rise has been increasingly lower, and this is connected with our first sloping trend line. A horizontal trend line is placed at support and contains the action. When the market does break through, sellers jump on board and push prices lower aggressively. The descending triangle pattern is a continuation pattern, meaning that it is contained within a downtrend and is formed by the consolidation within that period of the downtrend. The target is calculated by measuring the top of the sloping line to the bottom of the support and adding that to the bottom of the support line to calculate a target area. This has been a great example of a descending triangle pattern. This completes our lesson 1 of chart patterns. We will begin with lesson number 2, candlestick patterns, in our next video.